Okay, so picture this. It's the late 1980s, and there's this 25-year-old kid in New York. And well, he is completely broke. I mean, he's a literal door-to-door salesman out on Long Island, hustling frozen steaks and seafood out of the back of trucks. He's got ambition, for sure, but his business, it just totally collapsed. Boom, gone. He is staring right down the barrel of personal bankruptcy. And honestly, looking at him right then, there is absolutely no reason, none at all, to suspect that this totally ruined salesman is about to construct one of the most ruthless, aggressive corporate machines in modern financial history. A machine that would eventually generate just unimaginable wealth, but also leave this massive trail of absolute devastation in its wake. So who is this guy? And more importantly, what exactly was the magic product he found to turn absolute failure into total, undisputed dominance? A product with infinite supply and zero inventory. Seriously, you are not going to believe how this explainer unfolds.
To really understand the sheer scale of this business mystery, we got to look at the unit economics of where he started. Now, you have to know, this young salesman, he wasn't lazy, not at all. Actually, according to his own accounts, he was moving something like 5,000 pounds of beef and fish every single week. He even had a whole team of workers under him. But man, the physical goods business is just brutal. I mean, meat has spoilage, right? The logistics costs are an absolute nightmare, and the profit margins are just razor thin. The whole thing ultimately bled him completely dry, forcing him into bankruptcy by age 25. But, and here's the kicker, this massive failure taught him an absolute masterclass in business operations. He realized pretty quickly that selling physical, tangible goods with these tight margins, it's a losing game. To scale massively, he needed a totally different product to push, something that required absolutely no warehousing, had an infinite supply, and offered margins that you couldn't even dream of in the meat business.
Okay, let's dive into this and see how this crazy pivot actually happened. Because the man we're talking about is, of course, Jordan Belfort. Now, just think about the sheer speed of this super aggressive pivot. Back in the early 80s, before the whole meat business fiasco, he and a buddy actually made a cool $20,000 profit just selling Italian ice out of styrofoam coolers at Jones Beach. So the guy clearly had the sales instinct, right? Fast forward, the meat business goes under, and a family friend helps him snag a job as a trainee at the super prestigious Wall Street firm, LF Rothschild. But then, bam. The 1987 Black Monday market crash hits, the firm goes under, and he is out on the street all over again. But by this point, he's had a taste of the ultimate product. By 1989, he sets up a franchise of this tiny minor league broker-dealer called Stratton Securities. And pretty soon after, he just buys out the entire firm, completely rebranding it as Stratton Oakmont. And you know, his entry into this world wasn't some grand, pre-calculated master plan. It was just a highly opportunistic pivot. He finally realized that the infinite margin product he'd been desperately searching for, well, it was simply other people's money.
But structurally, Stratton Oakmont was a complete mirage. It totally lacked the fundamental architecture of a real corporate financial firm. What they really built was a classic boiler room. That was their core business model. Stratton Oakmont would eventually pack over 1,000 brokers into this incredibly high-pressure, chaotic environment in Lake Success, New York. But here's the crazy part. They had absolutely no product control function to verify the prices of the positions they held. None. There was no risk management department, they weren't sitting around analyzing market trends, and they certainly weren't poring over corporate balance sheets. Instead, this firm was engineered from the absolute ground up to be an industrialized sales factory, specifically designed to aggressively, relentlessly push microcap stocks.
So let's break down the exact financial mechanics of their wealth generation. It all relied on this highly organized, totally illegal corporate strategy known as the pump and dump. Step 1, the buy. The firm would go out and acquire a massive, controlling position in a really cheap, relatively unknown microcap or penny stock. And why microcaps? Well, it's simple, because they have incredibly low liquidity, which makes them incredibly easy to manipulate. Okay, step 2, the pump. That massive sales force we talked about, they would hit the phones using these highly deceptive, high-pressure scripts to create a completely false frenzy of demand. And because Stratton basically controlled the entire market for these specific low-volume stocks, they could just arbitrarily increase the price, even when there was zero legitimate investor interest. Zero. Finally, step 3, the dump. Once the price was artificially pumped up to the moon, the insiders at Stratton would quietly liquidate their own overvalued shares for absolutely massive profits. The price would then immediately plummet, crash into the ground, and those everyday retail buyers, they were left holding completely worthless paper. And this brilliantly illustrates the behavioral finance at play here, specifically the concept of loss leader investing. You see, they didn't just start off by calling people and pitching garbage. Oh no. The strategy specifically targeted wealthy individuals, people who actually had the capital to invest heavily. The illusion they sold was that Stratton Oakmont was this highly prestigious, super elite Wall Street firm. They would hook a new investor by selling them legitimate, stable, blue-chip stocks as a loss leader. They'd actually let the investor make a quick, real profit. And man, this built absolute, unshakable trust. But once they had that captive audience, boom, here comes the switch. The brokers would totally pivot, seamlessly transitioning the client into their high-margin, toxic inventory, those penny stocks that Stratton secretly controlled. And if the investor tried to back out or say no, the tactics turned incredibly ugly. Multiple brokers would literally jump on the same phone call, aggressively bullying and screaming at the investor into compliance. It was pure psychological warfare. So just how big did this get? 34. That is the number of different companies whose stock Stratton Oakmont successfully manipulated over a 7-year period. 34. This wasn't just some one-off fly-by-night scheme. This was an industrialized financial operation that issued over $1 billion in stock. $1 billion. This even included underwriting the massive initial public offering, the IPO, for the footwear company Steve Madden. Stratton intentionally structured that entire IPO to retain a huge percentage of the market share strictly for their own economic gain. They completely controlled the float. And why is controlling the float so incredibly lucrative? Because it means you completely dictate the supply. And in economics, if you dictate the supply, you can artificially dictate the price. During the review period, no other broker-dealer made a single purchase or sale of those warrants. Literally none. Stratton was the market. And they rigged the whole thing. But here's the reality of the financial world. A corporate operation this aggressive, generating this much noise, and ripping off this many people, it inevitably faces a catastrophic regulatory compliance failure. The tension was building for years. The firm was under near constant scrutiny from the National Association of Securities Dealers, the NASD, basically right from its inception. By late 1995 and into 1996, regulators were systematically dismantling their right to operate. They cited these wildly excessive and fraudulent markups, sometimes 16 to 66% over the prevailing market price. I mean, these markups fundamentally broke market-making rules. So, in December 1996, the NASD finally brought down the hammer. They permanently expelled Stratton Oakmont from the securities industry, citing an obvious disregard for all rules of fair practice. Just like that, the structural integrity of the business was completely gone. And when Belfort eventually wore wire and cooperated with the FBI, it wasn't some glamorous, dramatic spy thriller operation like you see in the movies. No, it was pure, desperate corporate capitulation. The final collapse of this operation wasn't some dramatic, high-stakes boardroom buyout. It was a total corporate bankruptcy and a systemic liquidation. After that 1996 expulsion put them out of business for good, the federal investigations officially culminated in 1999. Jordan Belfort and his partner, Danny Persh, were officially indicted for securities fraud and money laundering. Their entire business model was completely unsustainable and, frankly, mathematically doomed the exact second the regulatory liquidity dried up. They both pleaded guilty, fully admitting to the massive 7-year scheme. The empire was frozen, the fraudulent IPOs were unwound, and the top executives started scrambling to cut plea deals to save themselves. But as the smoke finally started to clear, the real story emerged, and it wasn't about the yachts or the parties. It was a story of extreme, devastating financial fallout. So the crucial point is this. Behind every single manipulated stock chart, behind every pumped-up penny stock, there was a real human being who was completely financially devastated by this so-called infinite margin business model. While the brokers were throwing wild parties, there were over 1,500 real-life victims left in the wreckage. Just think about these real people for a second. Steve Orton, an insurance agent down in Georgia. He lost over $68,000. Money he was specifically saving for his child's college tuition. Gone. Peter Springsteel, an architect who was just getting his business off the ground. He lost half of his entire life savings after taking just one cold call. Louis E. DeQueen Jr., an engineer. He was actually persuaded to move his hard-earned money from a trusted firm over to Stratton. He lost $250,000, and the sheer stress of it actually caused him to suffer a stroke. Or Dr. Alfred Witt, a dentist, who also lost $250,000. He struggled to even make ends meet after multiple brokers literally ganged up on him over the phone, becoming aggressively hostile the second he tried to stop buying. It's just heartbreaking.
And that heartbreaking reality leads us straight to this absolutely staggering number, $110.4 million.
This was the massive restitution order handed down by the federal judge at Belford's sentencing. Now, Belford was sentenced to 4 years in federal prison, though he ultimately only served 22 months. But as part of his plea agreement, he was legally mandated to pay back that $110 million to the everyday clients his firm ruined. But wait, remember what we talked about earlier? Stratton Oakmont issued over $1 billion in stock. That $110 million restitution, it represents just a tiny fraction of the total market devastation. It really brilliantly illustrates just how staggeringly inefficient and destructive this whole business truly was. And the worst part, while some funds were eventually recovered through property seizures, the vast majority of those victims have spent decades just waiting around for fractions of pennies on the dollar to be returned to them. Which finally brings us to the ultimate question of this whole explainer. We absolutely love the myth of the financial maverick, don't we? As a society, we are completely fascinated by this incredible rise, from a bankrupt door-to-door meat salesman to a corporate titan pulling in millions of dollars a single day. But when the Hollywood hype fades and the dust actually settles, who really pays the price for Wall Street's wildest structural frauds? Let me tell you, it's not the regulators. And it is very rarely the executives, who always seem to find a way to hide their assets offshore. No, it's the small business owners, it's the dentists, it's the engineers, it's everyday hardworking people who genuinely believed they were investing in their family's future, only to watch it completely evaporate just to fund someone else's delusion. So I want you to keep this question in the back of your mind the next time a financial pitch relies entirely on high-pressure urgency rather than actual underlying value. Ask yourself, are you buying a legitimate asset, or are you just funding the illusion?